One bank is rumored to sit on a mountain of silver, more metal than many governments could access on short notice. If that's even close to true, it changes the whole game. For years, you heard silver is dead and cash is king, while the biggest players were stacking quietly. They weren't debating opinions, they were building inventory. Welcome to the Reborn Historian, where we track what institutions do when nobody's watching. Because the real moves happen in silence, not on loud TV panels. Before we go deeper, hit like, subscribe, and turn on notifications right now. If you care about protecting your future, you don't want to miss the next piece of this puzzle. Keep one phrase in your head as we go. Stay alert. Turning points rarely come with warning labels. Start with a simple search. Look up the 2020 precious metals case tied to a major US bank. Don't read opinions. Read the official summary and see what it says. The penalty was roughly $920 million, and it focused on illegal trading tricks used to distort prices. That tells you the playing field hasn't always been clean. Here's the hard part. Fines punish behavior, but they don't automatically unwind positions or empty vaults. A firm can pay up and still keep what it accumulated. Now rewind to 2008, when panic forced fire sale deals across Wall Street. In that chaos, one failing institution carried a massive silver short that had to be absorbed. The buyer took on that exposure, and instead of sprinting away, they used time as their advantage. Paper pressure on one side, physical accumulation on the other. Paper markets can be moved with contracts that never require a single bar to move. Physical markets move slower because metal needs vaults, security, and logistics. When heavy paper selling appears at key moments, rallies can stall and sentiment can sour. And when sentiment sours, physical buyers get cheaper entries. Over the years, analysts watching vault data noticed inventory concentrating in certain places. That isn't mystery, it's method. Accumulate steadily while attention is elsewhere. People argue about exact totals, so don't worship one number. Focus on the trend. Estimates grew from tiny amounts to tens, then hundreds, then something massive. Put it in perspective. Global mine supply is measured in hundreds of millions of ounces per year, so one holder approaching a year of production becomes a market factor. Exchanges like COMEX can show huge open interest, but only a small slice becomes metal delivery. That gap is normal until trust shifts and more people want bars. When more traders demand delivery, weak spots show fast. Registered stocks, loadout times, and who can actually perform. That's when stress stops being theory. On some delivery days, the same name shows up as a dominant supplier. When one participant provides most of the metal, supply is clearly concentrated. Here's the twist that makes this urgent. There are signs big short exposure has been reduced in recent years. A shrinking short book can signal the keep it low era is fading. If a major holder stops benefiting from low prices and starts benefiting from rising prices, incentives flip. The accumulation phase turns into a profit phase. Do the math, and the stakes become obvious. A $1 move on hundreds of millions of ounces is hundreds of millions of dollars in valuation change. That's why institutions take years to build positions and months to manage the shift. They're not chasing daily candles, they're positioning for regime changes. And silver isn't just a chart, it's also a supply chain ingredient. Shortages don't look like zero silver, they look like delays, rationing, and premiums. Premiums are the real-world vote that screen prices can't fully control. If premiums stay elevated while the quoted price lags, the metal is tighter than it looks. Let's talk about the paper-to-physical ratio in plain language. If too many people demand delivery at once, the system doesn't explode, it changes the rules. That's what past commodity squeezes teach us. Margins rise, rules tighten, and cash settlement becomes more common. Those moves protect the plumbing, but they also reveal stress. And stress is exactly what long-term accumulators wait for. They want the moment when everyone realizes supply isn't endless. So what should you watch without drowning in hype? Stick to a few objective indicators that update consistently. These are the signals that matter more than viral clips. They show whether the market is loosening or tightening underneath the headlines. Number 1, vault inventory trends. Track registered and eligible stocks over time, because declining availability increases leverage in the system. Number 2, delivery concentration. If one or two players dominate deliveries, it means fewer real suppliers exist than the market assumes. Number 3, real-world premiums and lease rates. When borrowing or buying metal costs unusually more, the market is admitting tightness. Now layer in geopolitics, because metals become strategic the moment supply feels fragile. If major refiners or exporters tighten flow, everyone downstream feels it. A single policy shift can turn a balanced market into a stressed market. That's why governments sometimes treat industrial materials like infrastructure. You've heard claims about export licensing and strategic stockpiles in Asia. Even if you ignore drama, the incentive is obvious. Keep key inputs at home. When solar, electronics, and defense demand rises domestically, exporting raw metal becomes politically costly. Politics can move faster than minds can respond. This is why silver behaves differently than gold in certain cycles. Gold is mostly stored, while silver is stored and consumed. Consumed silver doesn't come back quickly because it's spread in tiny amounts across billions of products. Recycling helps, but it doesn't refill vaults overnight. So when inventories trend lower, replacing them is harder than most people assume. That's the tension behind paper price versus physical reality. About the famous corner attempt decades ago, the lesson wasn't nobody can influence silver. The lesson was leverage breaks when rules change. Leveraged players can be forced out with margin calls, but outright owners can simply sit. Physical ownership changes the power dynamic in a way paper cannot. That doesn't mean the chart goes up in a straight line. Markets shake people out, punish impatience, and reward discipline. The smarter frame is this. Big money moved early, and now the public is noticing the footprint. The question is whether you respond with research or emotion. Block 2. Here's what most casual investors miss. The silver story is being rewritten by engineers, not just traders. Some demand is increasingly tied to electrification, connectivity, and automation. Solar manufacturing uses silver in a conductive paste for contacts. Even tiny reductions per panel add up when installations scale into the trillions of watts. Electric vehicles use more silver than traditional cars because power electronics need reliable conductors. Multiply that by tens of millions of vehicles, and the pull becomes relentless. Then add chargers, grid upgrades, and high-voltage connectors that also rely on silver alloys. The demand isn't one headline, it's thousands of components. Now bring in 5G and the broader networking build-out. Every tower upgrade and every base station refresh pulls silver through switches and contacts. And the AI boom is a demand engine most people still underestimate. Data centers aren't clouds. They're industrial facilities packed with servers and power hardware. More servers mean more connectors, more high-reliability contacts, and more power routing. When capital spending accelerates, material demand quietly tightens. Companies can try to thrift silver, but engineering has limits. Silver's conductivity and corrosion resistance are hard to match without sacrificing performance. At higher prices, substitution research speeds up, but it rarely erases demand. It usually shifts usage rather than eliminating it. On the supply side, silver is unusual because most of it is mined as a byproduct. So a higher silver price doesn't instantly mean a flood of new silver supply. If copper, zinc, or lead projects slow, silver output can tighten even while demand rises. That mismatch is how deficits persist year after year. New primary mines are slow, expensive, and politically complicated. Permits, financing, and construction can take many years, even in stable regions. So the market leans on inventories when deficits appear. Inventories are finite, even if paper claims can be expanded quickly. That's why paper markets can look calm while physical markets feel tight. Paper can be created in seconds, but refined bars cannot. This also explains why price gaps between regions don't always get arbed away. If deliverable metal can't be sourced reliably, the loop breaks. Now let's talk about concentration risk, because it shapes volatility. When one institution holds a huge pile, everyone watches their next move. If that holder delivers into the market, rallies can cool temporarily. If they stop delivering or start accumulating, liquidity can vanish fast. That's why tracking behavior beats arguing online about motives. Behavior leaves footprints in reports, flows, and spreads. Some viewers ask, can regulators stop it? Regulators can change market rules, but they can't instantly create metal that isn't available. They can raise margins, limit certain trades, or encourage cash settlement. Those tools manage stress, but they also confirm tightness. The bigger risk is policy, strategic stockpiling, export licensing, or industrial prioritization. When governments treat a material as critical, free market assumptions weaken. You've seen the same playbook in energy, semiconductors, and rare earth supply chains. Secure supply, subsidize production, restrict outflow, and stabilize domestic access. That doesn't mean prices surge every day. It means the market becomes more sensitive to shocks because buffers shrink. So how do you approach this without turning it into a fantasy? Separate the long-term thesis from short-term timing, because timing is where people get wrecked. A thesis can be right, and your entry can still be bad if you chase spikes. Patience and position sizing matter more than bravado. Also, remember, silver can drop hard even inside bull phases. Liquidity events and forced selling can create brutal pullbacks. If you can't handle volatility, don't build a position that makes you lose sleep. There's no sure thing, only trade-offs you choose. Here's a practical checklist to keep it grounded. Read primary materials when possible. Court documents, exchange notices, and audited vault statements. Compare multiple data sources because one chart can mislead. If two independent feeds disagree, assume you need context, not certainty. Watch open interest relative to deliverable stocks, and watch how that relationship changes. When stocks fall while claims stay huge, stress is rising. Watch lease rates or borrow costs when available, because they show immediate tightness. Rising borrow costs are the market saying metal is scarce out loud. Watch premiums in your region, but don't confuse collector pricing with bullion supply. The cleaner the product, the better the signal. Keep an eye on industrial news, because that's where shortages surface first. Delays, long lead times, and special contracts are breadcrumbs. And when companies lock in multi-year supply agreements, that's a tell. Nobody does that unless they fear future scarcity or price risk. If you're wondering, is there still time? It depends on your horizon. Short-term traders live in weeks, but secular cycles can play out over years. The mistake is thinking you must choose all in or all out. Real strategy lives in scaling, diversification, and risk controls. And I'll say it clearly, this is not personal financial advice. Use this as a research map and consult a qualified professional if you need guidance. What I can promise is this. Markets reward people who watch the plumbing. They punish people who only watch hype and headlines. If major holders truly shift from resisting higher prices to benefiting from higher prices, the regime changes. In regime changes, narratives flip fast. So don't obsess over one dramatic number on one dramatic day. Follow slow indicators because they tend to lead the news cycle. The silver market doesn't announce itself with fireworks at the start. It whispers through small stresses that compound until everyone notices. You're early if you're studying structure before the crowd is screaming. Discipline beats excitement when volatility tests you. This is the Reborn Historian, and we'll keep tracking what the big players do, not what they say. Stay sharp, stay curious, and keep your eyes open.